New Landings Job Chat is brought to you in part by the Prosperity Advisory Group, the next step in your financial future, and by the EBS Group with an unparalleled background in Oracle solutions and services.
When you are out of work, there are a number of financial decisions to be made. What are they? Are some more critical than others? You'll find out the answers to this and other financial questions today on Job Chat. Your hosts are Hector Silva and Sarah Kane. Our guest today is Paul Ewing. Sarah, a little about Paul?
Definitely. Paul Ewing is the founding president of Prosperity Advisory Group. He is a certified financial planner and general securities principal with 30 years of industry and community involvement. Paul has won a number of awards over the years, including the 2011 KC Business Magazine Best Personal Wealth Manager in the KC area, and in 2011, he was listed among America's top financial planners by Consumers Research Council of America. He's also been recognized as a member of Barron's Winner's Circle. Welcome, Paul.
Good to be here. Thank you.
Well, thank you for being here. What are the critical decisions that have to be made as soon as you are unemployed?
So it kind of happens in a process. Initially, it's just a funk. Depending on how much time and advanced preparation you have, and depending on the circumstance that you find yourself in, you got to start by just taking an inventory, take a breath, and say, okay, where do I go from here? Now, we're big advocates for using the advice of a professional. It's what we do. So we do it every day, and while an individual may go through this once or twice, chances are that you're going to find a financial advisor that does this 20, 30 times a year, is helping somebody go through this situation. But whether you're working with a financial advisor or you're making these decisions on your own, I think there's just some basics. So let me kind of overview the 5 critical, and then we'll go back and spend as much time as you like with each of them. The first one is you have pension and equity compensation decisions to make. By equity compensations, I'm talking about those stock options or stock grants that are in the plan. Oftentimes those will vest or they will have cliff expirations upon the separation of service. So you've got some decisions to make about that. Then you have decisions to make fairly early on about your COBRA, the continuity of your health insurance. And that's an area that needs some pretty weighty discussion around. And then you know, you need to think about how are you going to survive the tough cash flow times that are ahead. In the unlikely case that it's going to take you longer than you'd anticipate. You have a decision to make about, are you going to relocate? And then finally, at the end of the tax year, before the tax year is over, while you can still influence things, it's time to take a good measurement of what the tax planning implications are of this unusual year, this break in income or increase in income, as the case may be. So those are the 5 areas, and we can talk about those now in a little more detail.
Good.
So,
let's start with the pensions.
Okay, so, well, you know, the pension decision seems like it's such an easy decision. The advantages to leaving your 401k where it is are the likelihood is, because it's invested as an institutional account, that you have lower expenses than you're going to be able to replicate by using an advisor. But frankly, if you want to have institutional pricing, you could probably replicate that in an individually directed IRA. The other advantage to a pension is that we all know that the rule for IRAs is 59.5. At 59.5, you're allowed to take distributions without a penalty. That's a lump sum penalty. Most people are not aware, however, that that rule is at 55 for a pension. So if you have someone who is over 55 that is looking at and saying, well, I can't access that is not an income source to me, they may be misguided. They may actually want to leave an amount of income or an amount in their 401k to cover any potential withdrawals they might need between the years of 55 and 59.5. But beyond age 59.5, there's no reason to leave a 401k when you can use an individually directed account. The key benefits are this. You're going to have a broader choice of investment options to choose from. You're going to be able to employ the services of an individual advisor who understands your circumstance, is not working for the plan, but working for your specifics. And then finally, when it comes time to take those benefits out for your beneficiaries, the flexibility and the ability to tax manage those are much greater in an IRA than they are in a plan. And I said finally, but there's another area that relates to this, and that's this whole area of 59.5 and lump sum distribution penalties. Most people have that ingrained in their heads, that's the rule, that there's a penalty for any money taken out prior to 59.5. But in reality, that's a lump sum penalty. Substantially equal systematic payments under Regulation 72T can be taken at any age. So the analogy is, if you were an NFL player, someone other than Peyton Manning, and retired before you were 40, then at the time that you retired, you're eligible to start taking that pension in substantially equal systematic payments, even though you're a long way from what we think of as retired in a traditional workforce. So those rules exist for good reason. Now, if you're going to do that, there are two things you need to know. One, the penalties for doing it wrong are pretty significant. So get help. Get a tax advisor, get a financial advisor who knows what they're doing. And two, those systematic payments must continue till the greater of your age 59.5 or 5 years, whichever's greater. So the 5-year rule is kind of silly, because if you're rolling it from a pension and you're less than 5 years from 59.5, you probably should just leave it in the 401k and take advantage of the 55-year rule, right? But beyond that, it just gives you more options. Something to consider for a small business startup. So if you're leaving the workforce and you think that it's become evident that you're going to be a small business startup, you may want to take your IRA as an IRA rollover, and don't commingle it with your other IRAs that you've contributed with your own funds, and hold that as a segregated account. And the reason is because once you start your own business, you can form an individual K, roll that IRA rollover into it. The unique characteristic of an individual K that an IRA does not have is you can borrow against that. You can take a loan up to half of its value, or $50,000 minus the highest outstanding balance in the last 12 months, $50,000. That could provide you funding if you're in a business startup situation where, while you wouldn't put the money in the business, it helps you keep your home afloat so the business doesn't have to do that for you.
I'm assuming there's pitfalls involved with that, though, things you have to watch out for.
Well, you have to do it right. If you default on the loan, it's the full amount of the loan becomes taxable in the year that it's defaulted on. It does not have the penalties associated with it that the 72T does, but it definitely needs to be administered correctly. And another great place where having a tax or a financial advisor that's versed is so important.
Now, going back to the 401k, should you roll it over, should you not? Can the employer force you to take it out?
There is a rule, and it's done by plan document, that if the plan balance is under a certain, what is considered a de minimis number, let's say it's $3,500 or $5,000, they can actually force a distribution because the employer doesn't want to forever have you on their plan. And by the way, they are the least service interested in you as a former employee. They just look at you and say, when are they going to take that? Because it's just a nuisance for them, and it's the benefits to them are none, and the benefits to you are few. It really comes down to a cost issue.
Wonderful.
How about COBRA?
Okay, so COBRA is the extension in which you can continue your employer's coverage for a period of time, and then you can buy permanent health insurance coverage. And this issue comes up a lot for clients who are in the financial position to be able to retire early, but retiring early relies on having health insurance. And so at age 65 is the current Medicare eligibility age, and so 63 and a half, because that's the 18-month extension with COBRA, is now the new early retirement age for clients. And what COBRA allows you to do is to continue the coverage. Now you pay the employer's full cost for that coverage. Okay, and most of us have very little appreciation who are coming out of a W-2 wage position, how much that health insurance really cost until it becomes their responsibility to pay for it under COBRA. It's expensive.
New Landings Job Chat will be back right after a word from our sponsors.
Hello, my name is William Easley, Managing Director of Wealth Management with Prosperity Advisory Group. A job loss is an unsettling experience that almost always challenges finances and lifestyle. Important decisions need to be made immediately that work toward protecting financial security, which include making significant adjustments to day-to-day spending habits. The obvious catch is how to make ends meet on less income. If you should find yourself and your family in this situation, you should begin by itemizing all of your current expenses, no matter how small, and assigning them as either fixed or discretionary. Examples of fixed expenses are mortgage payments or health insurance premiums. Discretionary expenses would include entertainment costs or that weekly dinner out at your favorite restaurant. The key is to eliminate as many of your discretionary expenses as possible and reduce your fixed expenses if able. More importantly, don't postpone these decisions even if you receive a generous severance package. You must tackle them right away. Your ability to maintain a wide array of financial options may depend on a proactive rather than a reactive approach to budgeting so that you can protect your other financial goals like retirement and the assets earmarked for them. Again, I'm William Easley with Prosperity Advisory Group, the next step in your financial future. Again, I'm William Easley with Prosperity Advisory Group, the next step in your financial future.
Hey, before we go much further on COBRA, I'd like to back a step
Sure.
for just a minute and talk
Go right
about
ahead.
equity compensation.
Go right
Restricted stock grants and employee stock option plans and employee stock option or ownership plans often have cliff
dates.
expirations that happen. You separate service, you have 30, 60, 90 days in which you either exercise the value that you're entitled to or it's forfeited. And I don't mean they're going to send you a check, I mean it's forfeited. So right away, if you're a participant in any of those plans, it's really important that you get tax and financial advice on those plans as quickly as you reasonably can. So to talk more about COBRA, you can save money if you, instead of using COBRA plans, you use a short-term medical plan. But you need to realize that at the expiration of that plan date, let's say you take a 3-month plan or a 6-month plan, no one owes you insurability beyond that. There's not the portability in that as there is in a COBRA plan.
So is the COBRA plan, is it something that you have to take or forget it if you go in a different direction, or can you go back to it?
In the first 30 days, you have important decisions to make about your COBRA plan. You can always drop the coverage, but you can't add it without insurability. In fact, you just can't add it. Now, it's interesting because your employer has a liability, a responsibility to communicate with you what all of your options are. And oftentimes they will outsource that to third-party companies who are experts in this area that will provide you all the guidance you need. And if you find yourself making a financial decision and you really don't, you're not tracking. They're saying things that sound like, but they're using different words, and you're not sure why they call this, and that, then it's time for you to stop, get a professional advisor to help you make that decision. It's such an important decision, and to spend an hour, to hire someone for an hour, it can be so critical to your family's financial future. Being uninsured in health insurance can be a fatal financial decision.
Cash flow. Some of us walk away from jobs and we have maybe a little something put away.
Right.
But we're going to have to make that last because we don't know how long it'll be before we have another steady income.
Right.
How do you handle that cash flow problem?
So let's start with just how big of a conundrum this is. First, a lot of clients, they're coming from executive roles especially, have been on the squirrel cage running so hard so long they haven't had any free time. There's been no travel that's not been business related. The house hasn't been kept up or improved since Hector was a pup, and now they have some free time. Now we all know that looking for a job is a job. I mean, it's fully engaging. It requires the same energy of having a job. But that being said, there's a pull to say, gosh, what if we took a little break? What if we went on a vacation? Adults don't get to take summers off, like we did when we were kids. What if I took advantage of that time? I think that's something you should discuss with your financial advisor and test that concept of what would be the consequence. Beyond that, fixing up the house ties in nicely with the next discussion of, are you going to relocate? And we're going to talk about that in a moment. But as you look at all those issues, I think that it helps you most if you can write it all out. Put all of the things you're thinking about and just put it on a list. And then sit down together and just say, good idea, okay idea, or bad idea, and just start to put an assessment to it. If you'll get with a financial advisor, they will do a stress test feasibility study for you. So they'll look at your financial assets, they'll look at your income objective, they'll look at the resources you have in future income, and they'll create a plan for you that says, look, if you have to live off of what you got for the next 12 months, and then you're going to need $50,000 to do a business startup, and then you're going to need to relocate, or then you're going to sell the lake house, or then all of these different scenarios. There are plans out there. There are tools that can build that for you and show you on a linear calculator. Now, a linear calculator assumes you're going to get the same return year after year after year. And in 30 years, I've never seen that happen. So the next step is, once you create the linear calculator, is you stress test it. So you randomize the results, you randomize the inflation rates, you randomize the returns, and you test it for the number of times that your plan will still be successful. Once you create this base plan, they're online tools. 52% of our industry uses the same tool. It's called Money Guide Pro. Once you have that, it's easy for you to go in and say, maybe it's not going to take me 12 months. Maybe I'm going to be able to do it in 10. Or maybe I'm going to do it in 14. It'll quickly tell you what that consequence will be on your long-term outcome. I think that's really important in terms of the overall effect.
So it's really good to start with an inventory of where you are, kind of a worst case, and then run a bunch of what-if scenarios.
Right. You make the list of all your options, rank them good idea, okay idea, and bad idea, and then you stress test it. Yeah. And it seems like such a big tool, but I promise you a financial advisor could whip at it 45 minutes.
And from a cash flow perspective, I assume that this also says, okay, assuming that you're going to get this return,
right,
this is the percentage that you can use of that
for current income.
Right. And that's what you base your cash flow on.
Right. So those of you who've managed balance sheets or managed income statements, what you're doing is you're taking your current inventory of assets and you're putting it in buckets and saying, I'm going to use this bucket for this purpose. I'm going to use, maybe it's a relocate. I'm going to use this bucket for an income supplement between now and the next job. I'm going to use this bucket and we're going to try to hold for long-term financial security post-retirement.
So relocation does take money.
Right. So let's talk about relocation for a moment, because I think that one of the first things you need to understand is the rules of thumb about what's happening in the real estate market are largely misguided and perhaps sending people in the wrong direction. Here's the thing. You want to say, well, the market's down. Terrible time to sell my home. Just it's a bad time. So I don't want to do that. Let's examine that. Market's down, a great time to buy. in certain markets. Well, let's examine that. And then let's put it to. I think the important test for you to start with, and this comes from interviewing my clients who are realtors, and I have a number that do volume realtors, and they've really helped me to understand it. And the way I communicate it to my client is, imagine the real estate market of 5 years ago. In our market, real estate, a home was worth about $100 a square foot. They were. It didn't really matter where it was or what it was. It was $100 a square foot, and they all sold pretty much the same in pretty reasonable time. But what's happened is that this market being oversold and an excess amount of inventory and a backlog of foreclosed properties that are still driving more inventory than we're driving sellers to the market, what you've got is you've got a market that's divided into quintiles. So the top 1/5 of the market, these are properties that are in ideal locations. They have ideal schools. They have ideal finishings. They have the marble in the kitchen. They have the walk-in closets. They have the bathrooms that remind you of the Roman spas. Those homes are selling for as much as they ever have, and they're selling as quickly as they ever have. That's the thing for you to take into consideration. So if you own one of those homes, you don't kid yourself into thinking that you're going to take a 20% hit on that home. That's not necessarily true. The second quintile homes. Now, these are homes that have much of that, but maybe not on a cul-de-sac. Maybe don't have the ideal school, or those homes are going to take a discount. And it could be 20 to 30% discount. Those are the homes that make the average that we talk about so much. You know, the average home is down 20 to 30% from its high. And it's going to take you much longer to sell that home. And you're going to probably get beat down on the price several times in the process. The third quintile home is really going to be a tough sale. So you're not fresh, you're not updated, you're not in a great school. By the way, no amount of marble you put in the kitchen is going to make up for a bad school. I mean, you know what I mean? It's like you just have to deal with what you deal with, and school's not important to everyone. You know, the thing to consider, you know, a big thing that's on the homes right now is if you've got a master bedroom on the first floor, that's a big issue because more and more Americans are considering this concept of aging in place. They want to have a home that they could live out their years. That's a tougher sale. And by the way, these top 3 quintiles are the market. So when they talk about the average sale price and the average activity, it's the top 3 quintiles because the bottom 2 quintiles, they're not selling to anybody for anything. They're going at auction. And they're not going into that
the equation
price range, right? So let's take that fact pattern, which is probably a deeper understanding of what the market is in real estate, in the residential real estate now, and with that assessment in place, if I'm looking at a relocation, I got a couple things in front of me. One is, I'm in this home. I could do very little to this home to move me from second to first quintile. That's probably not a bad investment. And beyond that, when I go to the next market, maybe I don't want to buy a first quintile house. Maybe I could look around and see if there's not a third quintile house that I could do a little something to make it a second or first quintile house. Do you see what I'm saying? Because that's where I'm going to get the deepest discounts. So, which comes back to the common phrase I tell my clients, I bet I say it once a week, this is not a great time to buy a house, but it's a great time to steal one. If you're willing to take the time to find that third quintile house. But don't expect to steal a first quintile house. I'm not saying it can't be done. I'm just saying I talk to realtors every day that says, I can't believe these people think that they can come in here what they think we're just going to give to them because they don't understand this concept.
So let's say that you're unemployed and you find a job in another city, in a different region.
In your field.
In your field.
Right.
Is the relocation of that house then actually important in the equation of whether you take that job or not?
Of course it is. And I think that's why we list this as one of the critical first decisions you make, is because you need to do that honest assessment of where you are, where your current home is in those quintiles. Because if you're in the top quintile and you had an opportunity in a market that you know is going to be hard to duplicate, you don't need to let selling your house hold you back. But if you're in a second or third quintile home, it's a different. If you're in a fourth quintile, it's a big issue. In fact, you may very well be looking at a short sale and give them the keys.
Okay.
Which brings me to two more topics in that area. First, the short sale. Fannie Mae and Freddie Mac just last week gave the advice to the mortgage industry to just write down your mortgages. Don't try to make somebody who owes you $400,000 on a $300,000 house. The loss has been done. Take the mortgage down to a level that's at least within the value of the house. The banks thus far have said, no. But the day is coming. You understand that the credit implications of a short sale are not what they used to be. They're just not. The credit implications are just not what they used to be. So don't rule out a short sale, even though emotionally it feels wrong to you. If the circumstance is correct, please understand, none of our listeners caused this mortgage crisis, caused this real estate crisis. And for them to be the ones to pay for it is just tough medicine. And I think that you need to be willing to take a look at that. The second thing for you to consider is my clients and friends in the mortgage industry tell me that 50% of the mortgage applications that they receive and process every day, 50% will be rejected over appraisal. In other words, the purchase came in at this price, the appraisal came in at this price, we don't have a deal. So just be aware of that and make sure that you don't sign any contracts that real estate contracts that don't have financing contingencies.
Tax.
Right. So this situation has a lot to do with the time of year that you're facing with decisions. It has a lot to do with what it does with incomes. It has a lot to do with where you are in bracket. So let's go from one extreme to the other. Extreme one, you just had an enormous cut in income. So this is the year where you might have been flying at this level, solid in a 33% bracket. Now you find yourself in a 15% bracket because your income dropped at this level, but your expenses and standard deductions didn't. Your mortgage expense, your property taxes remain unchanged. So in that year, you've got some major decisions to make. By the way, your health care now is deductible. Normally you would never get to see a health care deduction, because until it exceeds 7.5% of your adjusted gross income, it's not deductible. But that threshold went way down when the top line went down. So now you find yourself in a year where you're in a 15, maybe a 10, and maybe even a 0% bracket. That's a year to consider. Is this the year that I convert some Roth? Is this the year that I take an IRA distribution I didn't even need in order to take advantage of these low bracket years, because I know I'll never be in this low of a bracket again in my lifetime? Is this a year that I put off charitable deductions for a year when they make more sense to me from a financial perspective? Is this a year when I move it from one year, where I time things because of the time of the year that this happens? On the other extreme, you've got a year where your income has just gone through the roof because you had restricted stock grants that you had to exercise, and that all came to you as ordinary income, or you had stock options that came to you. You had no choice, and perhaps you had your severance package paid to you in a lump sum. We're seeing that increasingly. Employers are doing that. In that scenario, you've got some other choices to make. Now you're looking at saying, gosh, I am just pushed in the highest tax bracket I'll ever be in my life. Is this the year for me to fund a donor advised fund? In other words, set up a charitable fund that I pre-fund my future charitable contributions, so I get the deduction this year and I'll make the gifts in future years. Is this the year that I take advantage of my IRA? Look at all the different deductions available to you in that year and push it forward to future years. So all of that leads you to tax and financial advisors to get help.
Well, Paul, thank you. You have given us so much to think about, and it's definitely a lot of solutions out there, decisions to make out there. I know personally I've used professionals that have come up with solutions I didn't know existed. And they've made such a difference in my decisions.
That's great to hear.
Okay, so thank you so much for being with us, and hopefully you'll be back with us again.
Appreciate it.
Paul, if someone wanted to contact you, how could they get a hold of you?
Our website is prosperity360.com.
Great. Thanks, Paul. You can hear more advice and financial information from Paul Ewing on a number of other job chats and other topics. You can catch these and all other podcasts on our website, www.newlandingsjobchat.org, or just search for Job Chat on YouTube.
Until next time, may your days be full of health, happiness, and success.